Well, let's start chapter 16, the final chapter of the class, believe it or not. Chapter 16 is about financial planning and forecasting. What we're going to talk about is how to look at a forecasted financial statement, how to do one, the AFN equation, which is additional funds needed, reviewing forecasted financial statements, figuring out excess capacity, and then of course, kind of once we got a handle on some of this information, how do we make policy change or affect change in the additional funds needed calculation? What policies and procedures that we can undertake to make the number better, and so on. And so what they'll do in the PowerPoint is just give us an example, and you can see here we've got the beginning of a balance sheet. Part of it's on this slide, and then a little bit more is on another slide. And so you can see here we've got a 14 actual and then a 15 estimated. So the 14 is an actual number, 15 is what we project will be the next year. And you can see we're projecting increases in cash, receivables, inventory, and fixed assets are all going to go up. And then of course we look at the liability and equity side. Liabilities will go up, both accrued liabilities and AP. Notes payable will go up. Long-term debt will go up. Common stock stays the same, so we did not issue additional stock, and retained earnings will also go up. My income statement is right here. We're forecasting a very healthy increase in sales, $500,000 increase in sales. My variable cost, which is probably mostly cost of goods sold, is going to go up a little bit. So my fixed costs, my EBIT, earnings before interest and tax, will go up, which is good. Interest will stay the same. EBT goes up. Taxes go up because we have a higher EBT, and net income also goes up. We're going to pay 30% of our net income as dividends, and then the difference would be in addition to retained earnings of $45.78. Some ratios for our company. As they usually do, they give us ratios that aren't so good. So we've got 14, 15, and the industry average. And just a whole array of ratios here. Remember that we talked about ratios. I believe it was way back in like chapter 3. And you can see that for most of these we're underperforming compared to the industry average. The good news is that many of our ratios are improving from one year to the next between 14 and 15, but the increase is not spectacular, and a lot of them actually just staying the same. So it's not a whole lot of change between 14 and 15, but at least the movement is movement in the right direction for some of the ratios. So some key assumptions in preliminary financial forecast for net working capital. We're assuming that we're at full capacity in 14. So that means if we want to grow sales, our capacity will have to go up. So each type of asset grows proportionally with sales. Payables and accruals grow proportionally with sales, and then the 14 profit margin and payout ratio will be maintained. And sales are expected to increase by $500 million, so the percent change in sales down here is 25%. Now I just want to point out that quite often when a company does a forecast, you hold some assumptions to be true unless you know better. And so it's very common to say if we forecast a 25% increase in sales, then we will just simply forecast a 25% increase in assets and payables and accruals. That's very common to do it that way, that we'll just base growth of certain balance sheet items as the same level of growth in sales. Okay, so the heart of this chapter is the AFN equation, additional funds needed. So basically, as we grow, what do we need to add to capital? What kind of financing may we need to finance the growth? And the AFN formula is on page 573. There's a good write-up on that page about the AFN formula, but the formula, just like you see in the screen here, is also on page 573. So what we're doing is we're saying, what is our asset to sales number? And remember, 0 is today. So 0 is what are my numbers today? So I'm looking at assets to sales multiplied by my change in sales, liabilities to sales multiplied by my change in sales, minus M, which is my profit margin, multiplied by sales next year, S1, my sales next year, multiplied by 1 minus the payout. Okay, and so what this is trying to help us figure out is as assets and liabilities grow, I should say, compared to my sales number. So my change in sales is how much will sales go up. Sales is going to go up by 500,000, and so my assets and my liabilities will need to go along with those. So assets will go up minus my liabilities, then minus my profits. Okay, profits minus my payout. So M times S1 is my profit margin. My profit margin was the 0.252. Multiplied by 1 minus my payout ratio. So basically, how much of my profits next year will I retain? Because that's going to help me pay for my additional funds needed. So I need more assets because remember we're at full capacity. So to grow sales between 14 and 15, capacity has to go up, and we're going to increase capacity at the same rate as my change in sales, 25%. There's a cost to that, right? To increase capacity, I have a cost. I subtract that cost, which is basically my cost of increasing capacity is the first part of this. I back out the liabilities, and I back out basically how I will use retained earnings to pay for it. And I get 180.9. So I need 180.9 to finance that additional growth. Management's review of the financial forecast. Consultation with some key managers has yielded the following revisions. And so as we looked at that forecast, as we looked at the balance sheet, the income statement, all these ratios right here, we know we're using a lot of this information then to do the forecast. And we just did the AFN calculation. And now management's looking at the forecast and going, okay, let's talk about this. What are some things that we can do to improve the forecast? So consultation has yielded some revisions. The firm expects customers to pay quicker next year, so DSO will go to 34 days without affecting sales. Key number, right? If that change affected sales, we'd have to have a new sales number and a new change in sales number. But we're saying that we can reduce DSO to 34. DSO right now is 43.8 in the current year and 43.8 in the future year. So we're saying we can get that down to 34, which clearly is a much better number. A new facility will boost the firm's net fixed assets to $700 million. A new inventory system to increase the firm's inventory turnover to 10 without affecting sales. Because inventory turnover right now, let's go find it, is 8.3. So we expect to be able to be more efficient in our turning over our inventory. So the more turnover, the better for inventory, right? That just kind of is that symbolic of filling up my store, emptying it, filling up my store, emptying it. The more that happens, the better, right? That's the more inventory you're selling, the more profitable that you will be. Okay, so they're going to make some changes. DSO down to 34, buy a new facility or expand a facility, and spend $700 million in fixed assets, and then increase turnover to 10. These changes will lead to adjustments in the firm's assets and will have no effect on liabilities and equity section of the balance sheet or its income statement. So the new numbers for the forecast, so 14 is the same, but we're saying the forecast now will be a little bit different. We'll have more cash because we're going to get collected faster. That DSO is going to be only 34 days as opposed to almost 44 days. My receivables will go down because I'm reducing the DSO. So receivables goes down, but cash goes up. Inventory goes up still, but not as much as before. And then, of course, my fixed assets is going up to $700 million because of expansion. And then what's basically what happens then with our ratios based on that. And we're still poor on a lot of them, but DSO and inventory now improved the right directions, and they're much, much closer to the industry average now. So what is the net investment in capital for the company? And you can see I did this calculation for 2 years, for 14 and for 15. And the capital in 15 is net operating working capital plus net fixed assets. Okay, so net operating working capital. 625 minus 315 minus 190, and we get down to 1,125. Capital, that same calculation in 14 was 900, and so my net investment in capital is 225. So between the 2 years. I bumped something. So then the question becomes, how much free cash flow is expected to be generated in 2015? So free cash flow is how much cash the business generates above and beyond what it needs for capital investment to maintain growth. Okay, so this company is growing. So that's going to require some capital to fund the growth. So the question then becomes, will we create enough cash to finance that growth or not? And the answer is we will not. You can see here, so we take our EBIT, multiply it by 1 minus the tax rate. Our net investment in capital, we just calculated, was 225. So we generate 75 in cash, but we're using 225 capital to go up and increase our growth. So you have a cash shortfall of 150. It says here, suppose fixed assets have been operating at only 85% capacity in 14. They told us before that we were at 100%. And so the question then becomes, what would the sales forecast be? And how much sales could we support based on our existing capacity? So actual sales divided by the percent capacity says we could go to 2,353 of sales and be okay and not have to invest in expansion or growth. The forecast for 15 expects that, or exceeds that, I should say, because remember that was 2,500. So we still need to invest in plant and equipment in this scenario. So we're still short. We still need to get to 2,500. How can excess capacity affect the forecasted ratios? Sales wouldn't change, but assets would be lower and turnovers would improve. Less new debt, hence interest, lower interest and higher profits. Because we have less interest expense, profits go up. Earnings per share, ROE, liabilities to asset ratio, and times interest earned would improve. So basically what they're saying is, I still have to expand, but not as much, right? Because I had to do a 25% expansion in the previous example because I was at full capacity and sales went up by 25%. In this example, I'm at 85% capacity, so I wouldn't have to spend as much on increasing my property, plant, and equipment. So I would borrow less, therefore I'd be more profitable. How would the following items affect AFN, additional funds needed? Higher dividend payout ratio, that would be an increase to AFN because we'd have less retained earnings. So the more of our earnings we give to our shareholders means the less cash that we're keeping to be able to invest in the company. So that would increase AFN. A higher profit margin would decrease AFN. The more profits, the more retained earnings. That's good. Higher capital intensity ratio, that increases AFN. We need more assets for a given level of sales. Capital intensity measures how much fixed asset do you need for $1 of sales. So the more capital intense we are, the more property, plant, and equipment items we need to generate a sale. What if we pay suppliers in 60 days rather than 30? That would decrease the AFN because we're keeping our money longer, right? Trade creditors would be supplying more capital. Now, that's how that one would work, just from a numerical standpoint, but you have to be careful about that one too. Are we incurring any late penalties? Are we getting our suppliers upset with us because we're taking so long to pay them? Will they stop selling to us? So that one's a little bit tougher, but clearly the longer we take to pay our suppliers, the more money we keep and the less funds we would need to borrow or acquire from some other source. Okay, so that's a shorter chapter, but this chapter is really about figuring out what the AFN is, additional funds needed. That's really kind of the meat and potatoes of the chapter, and then figuring out what our capacity is, and then figuring out what our forecasted financial statements would look like. So I'll do another recording showing you the Excel, and if you